As a contractor, you live and die by gross profit margin. What do I mean by that? I mean, gross profit margin is a critical number that is going to determine your ultimate profitability as a business. And having a consistent goal and number that you're working towards when you're bidding and when you're managing projects is the thing that's going to make the difference, that will translate into being able to make a consistent profit on the bottom line and reach your personal goals. Hi, I'm Vicki Suter with Suter Business Builders, and for over 25 years, I've been helping contractors build more sustainably successful and profitable businesses, help them find more time in their day and reclaim the joy and fun in what they do again. And in today's video, I want to share with you what I have found to be an issue that really a lot of contractors struggle with, which is making a consistent profit on their bottom line, but more importantly, understanding how to bid for a consistent gross profit margin, which is really, a lot of times we think in terms of sales, right? Like you think about, well, I have to sell a certain amount. And that tends to be the place where a lot of contractors focus. But the thing I say, and that I've found over all these many years of working with contractors, is sales is important, but critically important to have those sales translates into profits is you need to be making a consistent gross profit margin. Now, before I jump into explaining more of that, let's just define a few terms here that I think are important. So first of all, gross profit margin. The word margin by definition simply means a percentage. That's all it means. And when you look at the margin for your projects or for your business, it's basically the rate of return that you're getting on the work that you're doing. So in other words, you have revenue, you have cost of goods sold or your direct expenses for producing that work, and then you have gross profit dollars. And then those gross profit dollars convert into a percentage rate of return. And so when I say that contractors live and die by gross profit margin, that's the number I'm talking about. And I'm going to show you an example of that in just a second, and I'll walk you through how do you think about this and look at this in your own business in order to be able to stack the odds in your favor of making a consistent profit. First of all, in gross profit margin, but then mostly when it all comes down to it on the bottom line. And I'll also talk a little bit about what are some targets that you want to have for your business that are like benchmarks for what do you want to be setting as goals. Before I get into that, one of the other things that we're going to talk about today is I'm going to give you some tools for being able to have a chart that you can use to be able to determine how much you have to mark up in order to get to that gross profit margin. So we're going to be talking about the distinction also between markup and margin, and what is the difference in those terms, and how do you think about that? And then we'll talk about how do you actually do a bid to reach your goal for a gross profit margin and ultimately a net profit margin goal. So let me just start with talking a little bit about markup versus margin. So if you can think about it, the word markup means I have to take whatever my cost is, my direct cost or my cost of goods sold, and I have to mark it up a certain amount to pay for overhead, and then I have to mark it up a certain amount to make a profit. So let's talk about those two terms. So when I talk about overhead and how much I have to mark up for overhead, it is a certain percentage that it costs me to run my business. So that's including things like, maybe office staff, rent, utilities, telephones, marketing, business development, internet, website, all those other costs that are the costs that tend to be less variable, if you will, in what it costs us to run our business. That includes probably salaries for you, your estimator, some of your, all your field downtime, right, is included in that number of what it costs you to run your business. And so it's really important that you understand what that percentage is for your business. And I will share with you a resource that will help you calculate that, because interestingly enough, a lot of contractors actually get that number wrong. A lot of times what they'll do is they'll look at their profit and loss statement and see a percentage down there next to overhead expenses and think that's your overhead break-even percentage, but it's not. And in fact, if that's the number that you're using, there's a very good chance that you will be losing money and maybe not even realizing why you're losing money when you're using that number. And I'm going to show you the formula for that as we go along here today. So the first thing is marking up enough to cover that overhead expenses, that percentage, and then marking up enough to make a profit. So whatever that profit goal is for you and your business, if that's 10%, 12%, 15%, you need to mark up above and beyond your overhead markup in order to make that profit. And I'm just going to say, a lot of times I see that people throw these numbers around and of 10 and 5 or 15 and 20, or, just random numbers of what they think the quote unquote market will bear for how much you can mark up for overhead and profit. And what I have to tell you is I have looked at thousands of financial statements over these many years that I've been doing this work. And what I will tell you is that oftentimes the numbers that get thrown around in the industry as like, what's my markup for overhead and profit, is not actually the real overhead and profit markup. Usually it's something else. Usually it's much higher than the numbers that get thrown around in the marketplace. So if you're a contractor who thinks, well, gosh, I can only mark up this much because that's what the market will bear, what I will tell you is there are other ways that contractors build in some of their overhead costs into their bids so that they don't show up as a separate line item. And we're going to talk a little bit about that today. I'm going to show you give you some ideas of ways that you can do that. So markup is how much I have to mark up to cover my overhead and then to make a profit. Margin works backwards. Margin says, well, here's how much my price is. Here's what my cost is. Here's what my gross profit dollars are. What is that rate of return on those gross profit dollars? Margin is always going to be a lower percentage than markup. So let me just say that again. Markup is always going to be higher than your margin, or your gross profit margin is always going to be a lower number. So it's important to know that, and I'm going to share a couple tables with you, but it's important to know that because sometimes people use those terms interchangeably and they absolutely are not. If you're looking for a 35% gross profit margin, you have to mark up closer to like 42 or 44% in order to get to that. So I'm going to show you that in the example here in just a second. So there's markup. How much do I have to mark up to cover my overhead, make a profit? And then there's margin. What is my rate of return? So I'm going to walk you through both of those and show you an example of how to calculate that for yourself. And then I'm also going to share with you a couple of tools. I'll give you some links down here at the bottom of the video that will walk you through how to calculate your correct overhead break-even percentage, and then also give you the access to a chart that will let you be able to easily see, hey, how much do I have to mark up to make my desired or goal gross profit margin? So let me go ahead and share my screen and I'll show you the example. So this is a little spreadsheet that I put together that will walk you through an example of how do you calculate your gross profit margin and come up with a price for your projects based on the goal that you have for your business. So we'll start out with, imagine that there's a project that you have, and let's say this project costs $125,000. So that $125,000 represents your materials, labor, sub, equipment, other, right? Like you calculated what all those, base cost is for doing that work. And then let's say you do the calculation that calculates what your overhead markup is. And I'm going to give you a link down here. It actually is at the bottom of the video, but also in this document, that will let you calculate your overhead break-even percentage. And that overhead break-even percentage is your overhead cost divided by your cost of goods sold. So that's what that percentage is. Again, this article will explain it in more detail, but for the purposes of this conversation, let me just use a number that I'm going to use here. And let's say your overhead break-even percentage is 33.5%. And one thing I recommend is that when you calculate your overhead break-even percentage, that you use a period of time to do that, at least 6 months and ideally a year, but you might look back at the last year or look at what the last 6 months have been and then determine what that break-even percentage is. So when I do this formula and I calculate this, if I mark up the 125,000 by 33.5%, that's an amount of $41,875. That represents how much I'm adding to my base cost of that bid just to break even. So my break even cost is $166,875. At that point, when you've marked up that much on a project, you have made nothing on the bottom line. If your overhead break-even percentage in this case is 33.5%. And then let's say I want to make a profit of 12%. So remember I said margin is always going to be a lower number than your markup. You have to mark up more to get less of a percentage on the bottom line. And I'm going to show you briefly a table for that. So if I want to make a 10% margin on the bottom line, I have to mark up 11.11%. Or if I want to make a 35% gross profit margin, I have to mark up 53.83%. So in other words, you can see that margin is always going to be much less. And so it's important that you understand, the first number, which is how much do I have to mark up, because that's what it cost me to run my business, right? That's a real percentage. And then secondly, what is my goal for net profit margin? So if I have a 10% net profit goal, if I mark this up, and I'm going to just say for the sake of conversation, I'm going to mark this up 12%. So if I mark this up 12%, then I'm adding to my base cost of $125,000 for direct cost, the cost of goods to do that work. I'm marking up $41,875 for overhead, and then I'm marking up another $20,000 for profit. So my contract price at that point is $186,900. Now, again, one of the things that you'll want to do is calculate for yourself how much do you have to mark up your bids just to break even. So you'll want to calculate and know what that number is. And then before you send out your bids, one of the key ways for you to make sure that you're actually meeting your gross profit margin goal or your net profit margin goal is to double check your numbers before the bid goes out. So if you have a gross profit margin goal of 33%, then if I take my contract price of $186,900 and then I subtract from it my direct cost or cost of goods sold of $125,000, that leaves me gross profit dollars of $61,900. And the margin is calculated by taking those gross profit dollars and dividing it by my contract price. So that's what gives me my gross profit margin. So remember when I started, I said contractors live and die by gross profit margin. So one of the things that you'll want to do is make sure that before your bid goes out is to check, hey, am I bidding at the level of the gross profit margin target I've set for my business? Now, general contractors and subcontractors are going to have different gross profit margins. Traditionally, subcontractors are going to have a higher gross profit margin than general contractors do. Reason being, it costs more for a subcontractor to run their business because usually there's more labor involved. Transactionally, there's more things that have to be done in a subcontract business than in a general contractor who hires a lot of subs to directly do the work. If you're a general contractor who self-performs work, you'll often find that your overhead percentage is higher. So it depends on, are you a general or a subcontractor? If you're a general contractor who does 5, 10, $15 million projects, your gross profit margin is going to be lower. If you do smaller projects, your gross profit, let's say, 25, 50, 100,000, 500,000, your gross profit margin is going to be higher. So it's hard for me to get into a whole dialogue with you here about like, what should your targets be? But what I'll say is you want to determine what that target is for you. And really a good way to do this is to start with the bottom line. So if I know that, and I kind of did a little bit of math here. So I said, well, if I calculate this so that I can see what's my bottom line going to be for my company, if I assume a 33% is the cost of overhead, then if I take 33% of my cost of goods sold, right? And let me just show you this math. You can see this is 33.5%. So it's, how do I know that? Because that's how much I marked this up here, right? So at 33, let me just change those 0.5%, then that's how much my overhead expenses will be. Now my overhead expenses, when I take that out of my gross profit, that leaves me a net profit of $20,000 or 10.7% on the bottom line. That's my net profit margin, right? Again, margin, rate of return, margin just by definition means a percentage. So one of the things I would say to you is that unless you're a contractor who does them in the multi-digits of millions of dollars in volume, then you want to be doing between 10 and 12% net profit margin. And that's after your salary. So if you're a principal and you're listening to this, your salary should be in there, and an adequate salary appropriate to the size of your business. So it needs to be at least $125,000 a year, and probably more depending on, again, the size of your business. So when you look at and you set a goal of 10 to 12% on the bottom line, now it starts to shift your thinking about, well, how much do I have to mark up for profit, right? So remember up here, we marked up 12%. That got us that 20,000 of net profit, which is what we have down here. So again, what I'm doing is I'm marking up during the bid process, but the final stage is to check my margins and do this math to make sure, am I meeting my gross profit margin target goals? So it's a really good practice that if you want to make a consistent profit right out of the get-go, when you're bidding projects, make sure to calculate and look at those numbers to make sure that you're calculating and you're getting to the gross profit margin that you're looking for your business. Now, I added this information down here really for the purpose of you being able to see how the math all works. But the key number that you want to pay attention to is to calculate that gross profit margin when you're bidding before that project goes out to the client for contract signing. So a few other things that I just want to mention here, because oftentimes you are not, there's a lot of dynamics to how your bidding work, right? Labor is your biggest risk item, right? So subcontractors, you get a contract price for. Materials, you can get a purchase order for. Equipment rental, you can get a purchase order for. But when it comes to labor and your labor self-performing work or doing any type of work on a project, whether it's project management, or site super, you have a lot of risk in that you don't have. You can give them the amount of hours that they have to do the work, which is important, right? But you don't have as much of a safety net as when you have a contract with somebody. So it's usually the place that you're going to want to mark up more than you will other places. So one of the ways to be able to get to your gross profit margin goal is to add an amount into labor that's a higher markup. So it's one idea. The second thing is that you always want to look at, when you're bidding labor, using the highest paid level for that position. So in other words, if I have a carpenter, let's say it's a lead carpenter. If I have a lead carpenter and I have some that get paid $28 and some that get paid $37, when I'm bidding, I'm always going to use the rate of $37. You don't ever want to bid by person. You want to bid by position, and you always want to bid at the highest paid level for that position when you bid work. That way, if there's turnover, you end up, prices go up by the time you do that project. That can really help create a safety net for you to know that the prices that you put into your bid are built in with the highest potential amount that you would have to pay for that position. Some other ideas is include some of your overhead costs and general conditions. So some ideas here are like things like tent facilities, travel, fuel, auto. You can also include some of those costs in with your labor cost as your base cost for labor. So you might just start with that and then maybe mark up labor with a 50% margin, which is one of my suggestions up here. So there's some different ways that you can strategize and put some of those overhead costs in your general conditions so that you are getting paid for that and not having to mark out overhead as 33%, but you're building in some of those overhead costs as line items in your bid. Now you might be thinking to yourself, okay, well, I did that, but how am I going to calculate my gross profit margin on the job before the bid goes out if I've included some of those overhead costs in my base bid costs? That's an important question to ask. And that's part of, as you're setting up your estimating system or your bidding system, you want to ask yourself that question. How can I separate that information out so that on my estimating side of it, my estimated cost, my budget side of it, how do I make sure that I can delineate those costs separately so that I know what my total markup is and my total gross profit margin is? So that comes down to how you have your bidding system set up. And I've seen people do this in various ways. So I don't have a steadfast system for you, but it is a good question you want to ask because you want to know what that number is before it goes out. Other things to include in general conditions are safety meetings, equipment, tools, trucks, that kind of stuff. And you also, really important is that if you do project management for your projects, there should be project management time built into those jobs. Even if you're doing that as a principal, or if you are, you have somebody in your office who's doing project accounting, that's another thing that you want to include in there, especially on bigger projects. Project coordinator, so that if you have somebody who's managing purchase orders, change orders, subcontracts, somebody who does that administrative side of it within your business, that is absolutely something that should go into cost of goods sold and part of your base cost for that project. And I also recommend that you job cost that time. It's the way that you can really get a more accurate picture of what it costs you to do that work. It's also a way to reduce your overhead costs so that you're not having to mark up so much for overhead. And it'll give you a better idea if you're really getting the gross profit margin or rate of return you want on your jobs. So those are just some ideas of ways that you can include in there in your cost of goods sold when you're bidding a project, some things that are really generally overhead costs, but you can include in general conditions. I hope you found this information helpful for you, and I really encourage you to, first of all, go make sure that you're calculating and you know your accurate overhead break-even percentage. The link is down there on the video again that will help you calculate that. Secondly, go grab that markup margin table so that you can be really clear how much you have to mark up in order to meet your desired gross profit margin goals and your net profit margin goals. I hope you found today's topic to be useful in helping you make a more consistent profit in your contracting business. And I will look forward to seeing you next time on the Profit Builder. I hope you've enjoyed today's video. And if you're looking for more ways to grow your contracting business, I invite you to make sure to go check out my book, The Profit Bleed: How Managing Margin Can Save Your Contracting Business. And in the book, I provide a bunch of great tools and resources that will help you implement your learning and help you develop better systems and processes in your contracting business to be able to create a more consistent profit. And for a limited time, I'm offering the book for free. All you have to do is pay shipping and handling. And if you go to the profitbleed.com/free, you can go ahead and check it out and get the book for free. Again, all you have to do is pay for shipping and handling. And the tools and the resources that you get in the book are really tools and resources I've used with clients for over 25 years that are proven, that will really help you get leverage in building a stronger, more profitable contracting business. All right, go check it out. That's the profitbleed.com/free. And I look forward to seeing you next time on the Profit Builder.